It started off as a soundbite, but President Trump's plan to abolish the IRS is in motion. The IRS budget is being slashed, with tax programs being shut down, and now with the rollout of the One Big Beautiful Bill Act, we are seeing the biggest tax reform in 100 years. Now, let me be extremely honest with you. Anytime you hear about changes in the tax law, some people are going to get angry, but my goal as a licensed attorney who is not your attorney, who keeps a copy of the federal income tax code in his office, is I want you to understand the changes, because anytime these changes happen, every financially savvy person asks the same question, which is how can I use these tax law changes to my advantage, which is what I want to show you how to do in this video. Now, before I give you an update on some of the tax changes, let me lay the foundation of what's happening, because 2025 has been an interesting year for taxes. The original proposal was to replace the IRS with the ERS, which is the External Revenue Service. The idea that was floating around was, instead of you going to work and then paying taxes, how about we collect taxes from tariffs, and hopefully that'll be enough to lower your taxes. Take a listen.
As I said in my speech last week, instead of taxing our citizens to enrich foreign nations, we should be tariffing and taxing foreign nations to enrich our citizens.
Well, now as we're approaching 2026 and we actually have some data on tariff revenue, let's take a look at how this is going. We are setting a record for tariff revenue in 2025 and are expected to collect up to $300 billion in tariff revenue this year alone. This $300 billion in tariff revenue for the United States government is more than we've ever gotten from tariffs, but it's not enough to completely replace the IRS, because in 2025, it is expected that the United States government is going to receive a total of $5 trillion in tax revenue, and that's including the revenue from tariffs as well. Now, in case you're wondering how exactly the United States government collects this $5 trillion, here's a small list of the different types of taxes that you're paying right now. Number one is an income tax. You go to work, you get paid, a percentage of your money is going to go to the government in taxes. Number two is your payroll taxes. That's things like Social Security, Medicare. This is your FICA taxes. This is what you pay on top of your payroll taxes when you go to work and you get paid. Number three are sales taxes. You go to the store and you buy something, you got to pay a sales tax. Number four are capital gains taxes. You buy a stock and you sell it for a profit. That is a capital gains tax you have to pay. Number five are property taxes. You buy a house. Well, every year you have to pay property taxes on that house. Number six is an estate tax. This is more reserved for the ultra wealthy, but if you die with a lot of assets and you pass these assets on, the government is going to tax you on those. Number seven is the tariff tax. This is what we've been talking about today. This tariff tax is if something is being imported from a foreign country like China into the United States, you as the importer, whether you were a person or a business, have to pay this tariff tax to the government. Number eight are corporate taxes. So a corporation, if they make a profit, they have to pay a tax on that profit before the owners of the corporation actually get a penny. That's why it's called a double taxation. But you have the corporate tax, then you have your state and local taxes. Certain states like California and New York charge much higher state taxes. And then I lumped everything else into number 10, which is other, which could be really any other tax. Your toll taxes, cigarette taxes, lottery taxes, and everything else into number 10. That's how the United States government is generating this $5 trillion. And this, I know, goes beyond some of the government taxes, because you also have state and local taxes here as well. But the government is generating $5 trillion by taxing you in many different ways. But the problem is then that the United States government is going out and spending $7 trillion. That's the estimated budget for the United States government in 2025, which means there is a $2 trillion deficit. So going back to the original idea of using tariff revenue to replace the IRS, what we can see now based off of almost a year's worth of data is that tariff data is not enough to replace the total tax revenue from the IRS, and it's definitely not enough to replace the expenditure for the United States government. Now, this helps us lean into what's happening with the tax plan right now and how it can impact how much money you're paying in taxes, which I'm going to get into in just a minute. But this is where, to reduce this deficit, the United States government can do two things. They can spend less money, which means reduce their spending, or they can work to earn more money, meaning generating more taxes. And what we're seeing happen today is that the United States government is working to spend less money in certain areas. For example, I've already talked about how the United States government is cutting back on expenses at the IRS by laying off around 25,000 workers. So yes, we are seeing places where the United States government is cutting back on certain expenses, But we're not seeing this earning more happen. Instead, what we're seeing is the opposite with the passing of the One Big Beautiful Bill Act. This is one of the largest tax reforms that we have seen in 100 years, which means many people, in fact, most people, are going to be paying less money in taxes under the new plan. And so this combination together of some expenditure cutting and less taxes is anticipated to increase the national deficit by another $3 trillion over the next decade. So now that you understand the foundation, let's go deeper into the specifics because many of these items are being rolled out as we speak. Now, this is where I also want to let you know if you're an investor or want to become an investor, I have put together a free investing masterclass where I will walk you through how you can get started as an investor and find hidden investment opportunities before everybody else. You'll see the exact framework that my team and I use to research investment opportunities before they hit the headlines, and you'll see how you can start researching investments and make investing decisions based off of data. It's a completely free investing masterclass. There's a ton of value in there, and when you register for the masterclass, you're also going to get access to market briefs, which is my newsletter for investors, for free at no cost. So if you want to get the investing masterclass and market briefs all for free, all you have to do to register is click the link down in the description below. The way I'm going to break this up is I'm going to start by talking about the tax changes for individuals, and then I'm going to talk about the tax changes for business owners and corporations. Big change number one has to do with the car interest payments. More specifically, if you buy a car between 2025 and 2028 and you finance it, that interest that you're paying on your car payment can now be deducted up to $10,000, assuming, number one, that you buy this car between 2025 and 2028. Assuming, number two, that you make under $100,000 a year or you make under $200,000 a year as a married couple, and assuming, number three, that that car is made in the United States, or at least, quote, final assembly is happening in the United States. If so, you can deduct up to $10,000 a year that you're paying on your car interest. Big change number two is if you earn money from tips, you no longer have to pay taxes on that money that you make from tips under $25,000 a year of tip income. And this rule applies if you make under $150,000 a year. If you make over $150,000 a year, you're not going to qualify for this deduction. But if you make under that and you're making that tip income, you don't have to pay taxes on the first $25,000 of tip income. Big change number three is you no longer have to pay taxes on your overtime income. So if you work a job and you work overtime and you generate more income, you do not have to pay taxes on the first $12,500 of overtime income, assuming that you're a single tax filer. And if you're filing your taxes as a married couple, you do not have to pay taxes on your overtime income up to the first $25,000 of overtime income. And this new tax deduction will apply to you assuming that you're making under $150,000 a year as a single tax filer or $300,000 a year as a married tax filer. The reason why I'm highlighting these three things specifically is because these three deductions did not exist prior to the year 2025. So these are brand new tax deductions that people qualify for, and you should also be aware that they are set to expire in 2028. And number four, and probably the biggest change for individuals, has to do with the Tax Cuts and Jobs Act, which now is permanent into law. Let me show you what that means. This is what the new tax rates are going to look like in 2026 because the Tax Cuts and Jobs Act got extended. This is assuming that you are a single filing taxpayer. If you're filing your taxes as a married person, the tax rates are going to stay the same. The brackets are going to be extended. So you can check what it is on the internet, but this will give you an idea what the tax rates are. If the Tax Cuts and Jobs Act was not extended, what would have happened is, number one, these tax rates would have gotten a little bit higher, and also these brackets would have gotten a little bit smaller, which means that for most people, you would be paying higher income taxes because your tax rates would have gone up. So here's what the Tax Cuts and Jobs Act is saying for single tax filers in 2026, and I rounded these numbers just to make it simpler. If you make under $12,000 a year, you're going to pay 10% of the income in taxes. So for the first $12,000 worth of income, 10% of that is going to taxes. For every dollar that you earn between $12,000 to $48,000, you're going to pay 12% of that money in taxes. For every dollar that you earn between $48,000 to $103,000 a year, you're going to pay 22% of that in taxes. For every dollar that you earn between $103,000 $48,000 and $197,000, you're going to pay 24% of that in taxes. For every dollar that you earn between $197,000 and $250,000, you're going to pay 32% in taxes. For every dollar that you earn between $250,000 and $626,000, you're going to pay 35% in taxes. And for every dollar that you earn above $626,000, you are going to pay 37% in taxes. And one of the key things that I want you to remember is that we have a marginal tax bracket system, which means if you are making, let's call it $100,000 a year, that doesn't mean that you're paying all 22% on that money because you're in this bracket. What that means is on the first $12,000 that you earn in the $100,000, you're going to pay 10% of that money in taxes. Then for every dollar that you earn between $12,000 to $48,000, you're going to pay 12% of that money in taxes. And then, because your top tax bracket is this one right here, for every dollar that you earn between $48,000 and $100,000, you're going to pay 22% of that money in taxes. That's how the marginal tax bracket system works. So for individuals, the biggest four changes are: number one, you're going to be able to deduct your car interest payments, you're going to be able to deduct your tip income, and you're going to be able to deduct your overtime income. And for most people, you're going to see lower income tax rates because the Tax Cuts and Jobs Act was extended. If it was not extended, tax rates would have gone up for most people in the United States. For business owners and corporations, there are 5 major changes that I want to highlight. And number one is that there is a new 100% Section 179 deduction. Now, what this means is if you are a business and you're acquiring some sort of heavy machinery, you can write off 100% of that item in your taxes in year 1. Let me show you how this works, and I'll make it a little bit more spicy for you then. Let's assume you run a factory and you have this heavy machinery and you buy this new machine that costs you $1 million. Before, you couldn't take a $1 million write-off in the first year because the tax code didn't allow for it, but now, because Section 179 has a 100% write-off, you can write off all $1 million that you pay for this machine in year 1 from your taxes. So if you made $2 million of profit, you spend $1 million on this machine, you now have $1 million of taxable income. But let's make it a little bit more spicy. Let's assume that you're a big baller. Or maybe you're not actually a big baller, but you look like you're a big baller on TikTok and Instagram because you are an Instagram influencer and you're making a profit of $30,000 a year. Now, normally when you make $30,000 of profit, you have to pay taxes on that income, like I showed you in the diagram just a minute ago. But because of this Section 179 deduction, you could do something a little bit unique. Because you are a TikTok and Instagram influencer, you might need some heavy machinery for your business. Not a factory, not something like that, but maybe a G-Wagon. Because if it's a vehicle, it has to weigh more than 6,000 pounds, which, yes, the G-Wagon weighs more than 6,000 pounds. And by the way, Mercedes-Benz has an entire page on their website of vehicles that weigh over 6,000 pounds because they know that business owners want to qualify for this deduction. So now, you make $30,000 of profit. You hear about the Section 179 deduction. So now, you might say, that would be nice for me to buy this G-Wagon, except you don't have enough money. But here's what you could do if you want to look like that big baller, and I do not recommend this to anybody. I'm just telling you how some accountants and tax attorneys think. Now watch this. You take $20,000 of your profit and you use that as a down payment on this G-Wagon. You still have $10,000 in the bank, and now you finance the other $80,000 out of this $100,000 G-Wagon. If you have a clever accountant and you can find a way that you're going to use this G-Wagon 100% for your business, well, now you get a tax write-off on paper for $100,000. Even though you have $10,000 in the bank here, but that means you actually, in the IRS's eyes, you have a loss, which means not only do you not pay taxes, even though you made a profit because you bought this G-Wagon, but you get to carry forward this loss to the next year and use it to deduct next year's taxable income as well, because that's what Section 179 is going to allow you to do. And if you want to take it one step further because you're having fun and you want to make it even more spicy, let's assume that you're a really big baller now. You're actually a big baller. And now you want to buy yourself a plane. Let's imagine that that's actually a plane. And this plane costs, let's call it $10 million. And you in your business this year are going to also make $10 million of profit. Well, what you could do now in this instance is you could take $2 million out of your business's profits and use that as a down payment on this plane. Again, you still have $8 million in your bank account, but but then you can deduct the value of this plane, which is that $10 million from your taxes, which means you have $0 of taxable income, even though you have $8 million in the bank, because now you got yourself a plane. So you got a plane, you got $8 million in the bank, and $0 in taxes because of this. Now we're going to talk about number 2, but I just want to make sure that this is clear that my goal is not to give you financial advice to risk your business's future to finance some expensive toys. My goal is just to get you to understand how the tax code works so you can start thinking like how accountants and tax attorneys think, not to spend your money stupidly. Use your money smartly to grow your business, and if you want to use the tax code, do it. Just understand the risks of spending money that you don't have. Big change number 2 is that the 20% qualified business income deduction was now made permanent. Let me show you what that means. Let's assume that you run a business. You made $500,000 of revenue, and you have, let's call it $250,000 a year in expenses, which means as a profit, you made $250,000. Now, generally, you have to pay taxes on the $250,000 worth of profit, but if you run a small business, something like an LLC or a partnership that qualifies, and you can just do a quick Google search to see if your business qualifies, what that means now is you're not going to pay taxes on all $250,000. You're going to pay taxes on 80% of this because you get to take a 20% write-off, which means you could just say, hey, because I am a qualified business owner, you're going to take a write-off of $50,000, which means you're going to pay taxes on $200,000 because you're a qualified business owner. Big change number 3, which is actually a detriment for business owners, is section 2740. And what this says is previously, if you ran a business and you provided meals for your employees, you could take a write-off for the value of the food and meals that you provided for your employees. So if you ran a business and you made, let's call it $100,000 a year, and you spent $10,000 on food and beverages for your employees. I know that's a lot of money to spend when you're only making $100,000 a year, but you get the idea. If you spent 10 grand on food and beverages for your employees, you could take a $5,000 write-off, which means, yeah, you spent $10,000, but you only get to write off $5,000, which means you would have to pay taxes on $95,000. That's how it was. Well, now under this new proposal, you don't get to do that anymore. You're not going to get a write-off on food and beverages that you provide to your employees. So even if you spend $10,000 on food and beverage for employees, it comes out of your personal pocket. You don't get a write-off for it. Number 4 is student loan relief. If you work for a company and you have student loans, this is good news for you because now there are ways for your employer to help subsidize and pay off some of your student loans and not pay taxes on that money. Take a read. Student loan repayments made by employers to their employees were temporarily tax-free to the employee, but now they are permanently tax-free. And change number 5, which isn't really a change, it's an extension, is keeping the corporate tax rate at 21%. Let me diagram how this works because I think there's a lot of misconceptions on how corporate tax rates work. Let's assume you are right here and you start this corporation right here. And now your corporation goes out and sells stuff and you make money and you have expenses. So you make, let's call it $200,000 and you have expenses of $100,000. So now you have a profit of $100,000. By the way, this is not for LLCs. I'm talking about C corporations specifically. If you have this profit of $100,000 in this corporation has to pay a corporate tax on that money. Today, the corporate tax was extended to be at 21%. If this tax code, the Tax Cuts and Jobs Act, was not extended, it would have gone up to 35%. But it's going to stay at 21%, which means about $20,000 of this money, $21,000, is going to go in taxes. So now there's going to be $79,000 left in this bank account, and that's when you as the owner can take some of this money out. So let's assume now that you take out $50,000 for yourself as the owner of the C corporation. If you don't know what a C corporation is, it's just a type of legal entity, kind of like how there's S corporations, partnerships. It's just a legal term, it's a type of business. If you take this $50,000 out, now you again have to pay taxes. So that's why it's called a double tax, because you're paying taxes at the corporation level, and then you pay taxes when you pull the money out for yourself. So as soon as you touch the money for yourself, you then have to pay taxes again. And this new tax law keeps the corporate tax rate at 21% instead of raising it to 35%. So what we talked about in this video is how the tax plan has been changing. The original idea was to replace the IRS with the ERS, but what we have seen is that although we are seeing a record amount of tariff revenue, it's not going to be enough to replace the IRS. That being said, we are seeing some ways that the government is spending less money. They're cutting the budget for certain entities, but we're also seeing less taxes go into the United States government because we're going to see lower tax rates. These lower tax rates are going to impact individuals and they're going to impact corporations. They're going to impact individuals through things like being able to deduct a car loan interest rate, to be able to not pay taxes on tips, to be able to not pay taxes on overtime income, and to see lower tax rates through the Tax Cuts and Jobs Act. It's also going to impact businesses through things like the 100% Section 179 deduction, through things like the 20% QBI deduction, through things like the 274O change, which will now not allow businesses to write off their meals and beverages that they pay for employees, through things like making permanent the student loan repayment plan, that businesses can help repay student loans and not pay taxes on that. And then number 5 is keeping the corporate tax rate at 21%. Now that you understand this, I hope you understand that there are things that you can do, such as the things I've just talked about, to potentially lower your tax rates. If you want to see more videos on practical steps on things that you can do to lower your tax rates, just let me know in the comments and I'll see if we can put together a video on that. Again, if you want some more resources on how you can get started as an investor and find investment opportunities, I have a full masterclass for you down in the description. And if you found value out of this video, the best thank you is a referral. So if you could, please share this video with a friend, a family member, a colleague, or a fellow investor. Thank you. The United States government owes more than $37 trillion. That means your tax dollars are being used to pay interest on all that debt. And this is where President Trump has been proposing a new plan to help pay off this debt involving gold and involving crypto. And most people have no idea of how this plan works or the implication of this new plan on your money.